Welcome to Talking Property. Today, Australia's best property analyst, Louis Christopher, and I are going to preview the end of the 2019 property market. Louis, thanks for joining us.
Nice to be here, Peter.
Louis, what's your forecast for the year end, please?
The forecast is that we're likely to see a bottoming out over the next 2 months. And thereafter, I think dwelling prices are likely to rise somewhere between the late third quarter, early fourth quarter of 2019. Our view is that we're going to see more and more buyers enter into the marketplace, and this is as a result of the changes with APRA, the Liberal election win, and the interest rate cut, and a likely another interest rate cut that will create an increase in the number of buyers, which will keep on picking up as we go into later 2019 and then into 2020.
The numbers are showing the Sydney property market year to date has pulled back somewhere between 4 and 5%, and you're suggesting that prices could rise on the back end of the year.
Yes.
By what percentage do you think prices would rise?
I think potentially we could see a 3 to 4% rise from the bottom this year.
Regulators and homeowners would probably accept a flat reading for the year given how soft the year begun.
We were on track for a larger fall, so our forecast initially was for a 6 to 9% correction for 2019.
And the enthusiasm that swept over the market, do you see this holding into 2020, or is this a case of dead cat bounce? Are we seeing something more fundamentally driven?
I think it will carry on into 2020. In my view, I think potentially this cycle could be relatively short. And the reason why we take this view is that we think the market's bottoming out from a high valuation base. The market is still somewhat overvalued, and so I think the probabilities of the regulators stepping in, if we do go into a boom phase, are that much higher. And I think that they would step in sooner than what they did with the housing cycle of 2012 to 2017.
So is that an acknowledgement or a comment, Louis, that regulators were probably too late to the party with that 2012, 2017 boom?
Arguably, they were a little bit too late. Now, of course, the Reserve Bank was trying to manage the overall economy, and during that time, they were managing a mining downturn over in Western Australia, which was affecting other states. So, of course, it's a very tricky job to manage the economy. But yes, I would say in hindsight, potentially, APRA and the Reserve Bank stepped in a little bit too late in the cycle.
If you're saying the market is bottoming out at a higher valuation, is that to also say that there's greater risks in the current market than what there might have been in 2012 for home buyers?
Yes, there are some risks there, potentially not some of the risks that others have argued. So we're not really seeing a massive rise in defaults, as an example, in the marketplace. There's not been a lot of forced selling activity in this downturn.
So whilst regulators are happy to see the market bottoming out, they by no means want to see back into boom mode.
No, I don't think the powers that be want to see the market go into boom mode.
What role is the reduction of interest rates playing in the market? Keeping in mind, I think it's really important that we acknowledge that interest rate cuts now look like happening globally, not just in Australia. New Zealand's already cut,
yes,
and the market is now suggesting that the US Fed Reserve will cut by year's end. So inexplicably, we're on a downward trajectory with interest rates globally again,
yes,
by the look of it.
Arguably, it wasn't a rise in interest rates which created the downturn in 2017. Of course, it was APRA stepping into the market. I look at it that potentially interest rates are still at fairly dovish levels. Arguably on their own, they would stimulate activity. What created this downturn, of course, was APRA stepping in and restricting lending. I think the combination of APRA loosening lending plus the rate cuts is what's going to stimulate the market. If it was just the interest rate cuts on their own, I don't know whether that would stimulate the market, but it's just a combination of forces which, in our view, is going to see more buyers in the marketplace, and I think we are seeing that now.
Do you subscribe to the theory that continued reduction in interest rates is a case of diminishing returns, where the more you cut, the less impact they have on the property market?
I think eventually you can get to that point. Let's just remember, though, that in percentage terms, a 25 basis point rate cut is a lot more in percentage terms compared to the existing interest rate that you currently have compared to, say, 10 years ago, when we were sitting on an average lending rate in 2008 of about 9.25%. You could argue it either way.
You're saying it could even be more stimulatory?
Arguably, yes.
What are the risks for home buyers and sellers that they should be watching for going forward from here?
Once again, home buyers and home sellers have got to get the market right. If you're a home buyer, you do not want to overpay in this market still, in my view. You want to try and get fair value or pay up to fair value, but if you overpay, you are at risk of the market turning on you once again. As a seller, even while there are more buyers in the marketplace, if you become overconfident with your asking price, you still will not sell. You've got to meet the market.
Taking the contrarian's view, is this a case of regulators trying to rescue a bubble, Louis?
You can overmanage an economy, in my view. I would have thought it's all about trying to manage a housing cycle and an economy at the edges, trying to let the economy do its own thing to an extent, but obviously taking action to avoid potentially a recession. The Reserve Bank's mandate, of course, is to try and achieve full employment as much as possible within the bounds of operating to an inflation target. At the moment, we know the Reserve Bank of Australia has been under achieving in terms of that inflation target. They've actually been trying to get inflation in the economy and have been failing as a result. On the housing market, though, there are ramifications for what they are trying to do, whether it's in the form of cutting interest rates or other stimulus activity, which can create a new boom in the housing market.
There's a lot of doomsayers, and have been for a long time, about the Australian residential property market, who have been saying that the market is set for a 40% fall.
Yes.
Where have these doomsayers got it wrong?
Their track record's just appalling.
Their track record is appalling,
you know,
I grant that.
One thing I always accept is the view that there's too much debt in the system, that debt to GDP levels in this country are high, and I agree with that. Where I've always differed with them is that I believe that there's been up until now bullets available, options available for the regulators to respond to the events, and they have been responding. Arguably, there's still ammunition left to respond to this scenario. Now, whether it's a right or wrong thing, that's a debating point in terms of debt to GDP levels. For me personally, I do believe there's still too much debt to GDP. How you respond to that, how you manage that, is where we differ. And as mentioned, how long this actually can go on for is also another matter of point of difference.
Look, it's a great point you make that regulators still have options available to them. Would you like to just expand on what those options are for anyone that's thinking about buying or selling but nervous about the 40% drop discussion?
There's many things that the regulators can do. So at the moment, we've got a cash rate of 1.25%. The Reserve Bank of Australia can bring that down to 0%. They could do that over a number of cycles. They could do 50 basis points now, save another 50 basis points for the next cycle, and basically then introduce quantitative easing, which of course had an effect overseas. It had an effect in the United States. It had an effect over in Europe. So the Reserve Bank of Australia could actually incorporate that. And then, of course, we have the federal government, where they could create stimulus in the marketplace. They could bring in a massive first home owners grant scheme worth $50,000 if they wanted to. They could create tax concessions, additional tax concessions for property investors. There's so many things that the regulators could do to basically fend off that type of major correction in the marketplace. Whether they do it or not, it's another matter, but there are definitely tools at their disposal.
I have seen one of the doomsayers speculate that they see a case post-election that whoever won would look to crash the Australian dollar. Do you see that as something that would help the market?
Once again, a lower dollar would be a tool at the regulator's disposal, no doubt. When you have a low Australian dollar, that has a history of stimulating economic activity. Calling it a crash, though, I know that's sounding pretty aggressive, and I don't know whether they would crash the dollar. Try to potentially manage the dollar downwards over potentially a longer period of time may well be a choice there. And let's keep in mind, of course, that the Australian dollar has already fallen. Once upon a time, it was at $1.10 US, and now we're struggling to hold 70 cents.
What's really important to point out is that when the US were printing money through quantitative easing and had zero interest rates, yes, the Australian dollar against the US dollar did get up to $1.10.
Yeah.
But was that a case of the Australian dollar rising to $1.10 or the US regulators crashing the US dollar.
Well, it was a combination of factors,
That's
including
right.
the fact that at the time, commodity prices were a lot higher, commodities industry was doing very well.
First home buyers were given incentives during the election by both sides, Labor and Liberals, so there are always going to be winners out of the election. In Sydney, we've seen a lot of high-rise apartments in suburbia that the market largely is unloved largely by the market. What role do you see first home buyers playing in absorbing the oversupply of high-rise apartments in suburbia around Sydney?
Yeah, good question, Peter. I mean, we have seen a pickup in first home buyers, but we still have a surplus of stock out there right now in the marketplace. One thing that people are not particularly aware of right now is that Sydney's population growth rate has actually slowed a little. And this was recently updated by the Australian Bureau of Statistics. So up until last year, the Sydney population growth rate was running at about 1.7% per annum. A revision occurred recently, which basically recorded that Sydney's population growth rate, or estimated population growth rate, had fallen to 1.5% per annum. Now, that may not sound like much, but it does have an influence in terms of underlying demand for dwellings.
What does that work out in terms of number of people, please, Louis?
Well, New South Wales has been growing at about 120,000 people a year. So that's come off effectively by some 10,000 odd people. Importantly, it's had an impact upon the underlying demand for the number of dwellings. So we've worked out now that the number of dwellings required each and every year to fulfil new demand is about 46,000 dwellings. It was actually over 50,000 dwellings a year. And this now occurring during a time where we've got oversupply is one of the reasons why we've been recording large rises in rental vacancy rates in Sydney.
Louis, just changing tack for a moment, what do you think will be the best locations, suburbs or segments of the market between here and year's end?
I believe potentially we could see that those regions which have been hit the hardest in a downturn have a bounce back. So, for example, the inner west, on our numbers, the correction in the inner west from peak to trough was along the lines of about 17% for houses. So a fairly large correction.
Would you call that a crash or a correction?
I call that a large correction. Keep in mind that the inner west really outperformed between 2012 through to 2000 and early 2017. Arguably, it went up a little bit too much compared to the rest of the city.
So it gave back some of its excess gains.
It certainly did. Now, we could potentially see a bounce back in the inner west and other regions which also had a major downturn.
On the later stages of that downturn, Louis, we saw a lot of discretionary vendors say, if that's what the market's doing at the moment, there's no way I'm selling into this environment. And suddenly home buyers that were reading in the media about this massive property crash or correction were going out into the market and they weren't finding any vendors that were happy to play ball.
Yes.
Right now, home buyers are anxious that they can't find enough stock on market.
Yes.
What role does stock on market play?
Well, it plays a significant role. If there's not enough stock on the marketplace and you see a sudden surge in buyers, potentially you could see a snap up in prices if the buyers are eager enough to buy whatever is there on the marketplace. I think it's very noteworthy because this downturn, we didn't see a lot of forced selling activity. Mortgage default rates, while they edged up a little, they still remained at fairly low levels. So you weren't seeing a lot of forced sellers in the marketplace. But what you were seeing, and this is why we do think that sellers will come back to the market, was a situation where would-be sellers had to basically put their affairs or their plans on hold because they couldn't sell or they refused to sell at the lower price. So now with potentially more buyers in the marketplace, you could see those sellers come to the marketplace. So what I would call pent-up selling activity, pent-up sellers who basically want to now come to the market. They want to change, they want to upgrade, they want to downgrade. They weren't willing to do it before because they couldn't get the price they wanted for their property. Potentially they now can. And so that's why I do believe we will see a pickup in listings.
So in summary, Louis, we're down 4% for the year, but we're likely to see a 3 to 5% bounce on the back end of the year, leaving us about where we started.
I think that's what's going to happen, Peter. I think if we are to get another interest rate cut, then I'm going to be even more confident of that forecast.
Louis, excellent information today. Thanks as always.
Thank you, Peter.
And thank you for joining us today on Talking Property.